The Consumer Price Index was released for November, showing the inflation rate is currently 6.8%, equaling inflation rates of 1982. The CPI rose 0.8% in November alone, which is the largest increase coming from energy costs, food, and used vehicles. I'm going to break down how this is affecting companies and what stocks to be invested in for 2022. But before we get into that, don't forget to like and subscribe and stay tuned for more content. If you don't already know, the CPI measures the average change in cost of prices paid by consumers, and it even breaks down where the cost increases come from based on geographical regions. If you haven't already watched my Investing 101 video, inflation is the decline of purchasing power of a currency over time, and companies have been using this measurement to increase their prices. Most companies are even seeing their profits at an all-time high in more than 70 years, even though they complain about inflation hitting their consumers. Even Dollar Tree, which thrived during an economic recession, announced in their recent earnings call that they will be increasing their prices to $1.25, citing inflation and supply chain issues. Mix that with COVID-19 supply chain issues, you have limited supply with an only increasing demand. But how does that affect the stock market? Growth stocks may do better when interest rates are low and expected to stay low, but many investors shift to value stocks as rates begin to rise. The Federal Reserve Chairman Jerome Powell already announced that they plan on tapering rates in 2022. So while over the past 2 years the market may have reached all-time high with tech stocks leading the way, the stock market also hit a high of over 1,000 IPOs, leading investors to try and maximize their growth. This has left stable and valuable companies in the shadows. However, during times of inflation, the stock market looked to value stocks, relying on companies with solid cash flow to combat high inflation. And a value stock refers to a company that trades relative to a company's fundamentals with things such as profit, earnings, high sales, and a stable dividend. So while growth stocks may have had a massive run over the last decade, here's a list of some stocks that'll have some stability during times of high inflation. I broke these down into 4 sectors: tech, retail, healthcare, and banks. Within the retail sector, consumer spending remains relatively stable, so companies such as Walmart, Costco, McDonald's, Starbucks receive stable earnings and profits. Some companies within the healthcare sector, such as Bristol Myers, Abbevie, Johnson & Johnson, CVS, and Walgreens, facilitate in the creation and distribution of medical supplies, which should not be affected during inflation times. And the banking sector will benefit on the rising interest rates, so stocks like JP Morgan, Bank of America, Citigroup, and Wells Fargo's will benefit. And within the technology sector, which greatly benefit from the growth of 2021, will likely see investors leave to more stable sectors to weather the volatility. Some stocks that may be safe during this time are those with a massive asset war chest to pay down liabilities and who have a high user base with an increasing earnings. This would include companies like Apple, Microsoft, Google, and Facebook. So although inflation may have many investors worried, there are fundamental steps that you can take in order to prepare yourself for upcoming shifts. And here's legendary investor Warren Buffett on how to benefit in times of inflation. But before I go, don't forget to like and subscribe and stay tuned for more content.
Yeah, well, inflation, Keynes said it many years ago that it's an invisible tax that only one man in a million really understands, and it's a tax on people that have had faith in their currency that the government's issued. The best protection, the best investment against inflation is to improve your own earning power, your own talents. Very few people maximize their talents, and if you increase your talents, they can't tax it while you're doing it. They can't take it away from you. So if you become more useful in your activities, your profession, doctor, lawyer, whatever it may be, that is the best protection against a currency that might decline at a rapid rate. And the best investment, passive investment, I think, is a good business. If you own an interest in a good business, you're very likely to maintain purchasing power no matter what happens to the currency. But it's interesting. In the United States, the value of the dollar since I was born has declined by 94% to 6 cents. So inflation is a very cruel tax on people who believe in fixed dollars, but things can work out pretty well even during inflationary times. I mean, if somebody told me when I was born, that the dollar bill is going to go to 6 cents, I might have said, let me go, let me go back. I'm not interested in emerging into that kind of a world. But actually, it's worked out pretty well, so I have no complaints.